In the last video, we left off at multiple choice question number 52 on page 1233. This involves an involuntary conversion. Patty's garage, used to store business property, is destroyed by fire. She decides not to replace it and uses the insurance proceeds to invest in her business. The garage had an adjusted basis of $50,000. All right, so I changed then. It says if the proceeds were $20,000, I changed it to $18,000 in this problem. What is Patty's recognized gain or loss? So in this case, Patty did not use the proceeds to replace the garage. Therefore, the loss is reduced by the amount of the insurance proceeds that were received. So she has a $50,000 basis less the $18,000 proceeds. So the involuntary conversion cost a loss to Patty of $32,000. But in the second scenario, part B, she receives $58,000 using my numbers. So with $58,000 proceeds, the question is, what is Patty's recognized gain or loss in this case? Well, in this particular situation, the proceeds exceed the basis of the garage. Therefore, Patty has a gain of $8,000. Again, using my data, $58,000 minus $50,000, which is equal to $8,000. For number 36, this deals with an installment note, and this is found on page 1229. So number 36 is where Alan sold a note held for investment to Stan for $50,000 plus an installment note receivable of $250,000, and it'll be payable in 5 equal annual installments. A couple of things going on here. One is that we have $48,000, which is the number I changed. It's 50 in the problem, but I changed it to $48,000. That's cash received, and so that'll be part of the amount that is received on the note. And in problem number 36, we have a situation where we have an installment contract, and this is found on page 1229. And number 36 says that Alan sold land for investment to Stan for $50,000 and an installment note of $250. Well, I changed the $50,000 to $48,000. So we have $48,000 plus the $250. This is the total value then received on the contract, and the basis of what is being given up is only $150,000. So then if we take the $250,000 plus the $48,000 and then deduct the basis of $150,000, we have the realized gain. So this will be the gain we'll be recognizing over the 5 periods. First, we need to calculate the gross profit percentage, and that's approximately 50%, which is the gain, total gain of $148,000, again divided by the $48,000 plus $250. So we have about 50% gross profit percentage. We're going to use this gross profit percentage then to determine how much gain we're going to recognize for each cash payment received each year. Well, in 2018, all we received then is we received the $48,000 in cash. That's it. So for 2018, which is what the question asks us about, we'll take 49.66%, or about 50%, and we'll multiply it by the $48,000 cash received. And then every year we'll multiply this gross profit percentage by the amount of the installment note received to recognize the income from the installment contract for that year. And then finally we'll look at number 40. Number 40 is found on page 1230. Where Marcus purchased Vinnie and Marie's personal residence for $225,000 cash and the assumption of their $100,000 mortgage. So if I change the value, sale price of the home, not to $225,000 but to $227,000, otherwise the data remain the same. All right, so we have the sale price of $227,000 plus the mortgage assumed of $100,000. Basis on the home was $275,000, and I just put in the exclusion amount by law that a married couple filing joint can take on the sale of their personal residence if they qualify. So the first thing I wanted to calculate then was the gain on the sale of the house. Well, here we're going to take the sale price of $227 using my data, and we're going to add to that the $100,000 loan assumed, because that's value received by the seller, and then we'll deduct the basis of the property, which was $275,000. And then that gives us the realized gain on the home of $52,000. However, the amount to be recognized is zero, and the reason it's zero is because this gain on the sale of their residence is less than the exclusion amount of $500,000. Therefore, they don't need to recognize any gain on the sale of this home, and this is permanent. This is not a deferred, this is a permanent non-recognition of that gain. If you have any questions on these or any of the problems in Chapter 12 or any of the concepts therein, please let me know.